Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So today's video is all about an annual cash flow strategy that was presented to me by one of you, one of the many subscribers to the Number Crunch Nerds YouTube channel. Here's the original email from you right over here. So let's jump into it. Starting right here, why doesn't anyone discuss using Roth conversions to fund annual spending? Here is the example math provided by this viewer for us to follow. So it says $200,000 of total income consisting of $50,000 in Social Security and $150,000 from a traditional IRA. So the strategy is $50,000 goes to a Roth growth account and $100,000 from the traditional IRA and the $50,000 from Social Security is used to cover annual expenses and taxes. Annual spending, I believe this is supposed to mean sits. So annual spending sits in a money market account like SPAXX and gets about 4% per year. Okay, so before we continue reading through the example, we're going to put this information that we just went through into a calculation. We're going to do that right over here on this tab called Number Crunching Results. And we're going to start right here with an opening balance in a traditional IRA of $150,000. Let's go back to the fact pattern and confirm that. So the total amounts that we are dealing with is $50K in Social Security, which we will account for in a few minutes, and then $150,000 in a traditional IRA. So that is where we're starting right here. Now it says typical method is to convert $50,000 to a Roth growth account on January 1st. And then draw from a traditional IRA on a monthly basis as needed. The traditional IRA might have taxes withheld or pay taxes monthly. So let's summarize this part. What this viewer has defined as the typical method is we're going to do a $50,000 Roth conversion. So of this $150,000 total starting point in the traditional IRA, $50,000 of it will go into the Roth account. $100,000 will remain in the traditional IRA, and that remaining $100,000 is the amount from which we will take monthly distributions to cover expenses. So going back over here, this section right here that I'm circling now, that's going to be our traditional IRA. We're going to call this scenario number 1, which this viewer defined as the typical method. We're going to set this up for 1 year, which is what the viewer is talking about in this example. So this 150 will be the opening balance on January 1st. Then we're going to have the $50,000 Roth conversion also on January 1st, leaving the $100,000 balance after the conversion that we will take distributions from to cover annual expenses. Now I'm going to apply the 4% rate of return that was mentioned in the example to both the traditional IRA as well as the Roth IRA. So right here, if I double click on this cell, you can see we're taking the $100,000 balance after conversion and we are applying the 4% annual rate of return to it. However, make sure to note right here that since we are doing this example by the month, since this example was defined to be a 1-year annual cash flow spending strategy, so if we have an annual rate of return like 4%, but we're going to do monthly compounding for this example, we have to divide the annual rate of return by the number of compounding periods. In this case, it would be 12. That's how you take an annual growth rate and apply it on a monthly compounding basis. So continuing with the example, we have the $100,000 starting point after the $50,000 conversion. The earnings on that is going to be $333 for January. That gives us a balance after the return of $103.33. And then I have determined that the amount of distribution that we can take per month in this example is going to be $8,515. And what that amount of distribution will do is it will bring the $100,000 starting point on January 1st down to $0 on December 31st. Because remember that we're kind of looking at 1 year in isolation. The viewer is saying start with a $150,000 balance, and we're going to use that $150,000 balance on a monthly basis to cover living expenses. We also have to account for the 4% rate of return that is compounding each month. So taking into account all of those factors, a monthly distribution of $8,515 is the amount that will bring the balance down to exactly zero at the end of the year. So just continuing the example into the next row, the ending balance right here will be this balance after we calculated the monthly return, less the distribution that we just took for that month. At the end of January, the balance in the traditional IRA will be $91,818. That balance will carry over here to the beginning of February. We have no more Roth conversions in this example for the rest of the year. So the balance after the conversion and the balance before the conversion will be the same for all months between February and December. We calculate our return following the same method as we just went over right up here. We get our balance after return right here. We take our monthly distribution to cover expenses right here, and this will be the ending balance at the end of February. And then the process just continues for all the remaining months through December 31st, and we wind up with a balance of zero. Okay, let's also note that part of this viewer's strategy was to convert $50,000 into a Roth IRA, what the viewer defined as a growth Roth IRA. I want to clarify that calling this a growth Roth IRA is just a viewer-defined term. This person is basically saying, I'm going to have multiple accounts. This one over here, I'm going to designate as a growth account, meaning I'm not going to take money out of it and spend it for monthly expenses. Whereas over here in this traditional IRA for scenario 1, we are going to take monthly distributions to cover expenses, and therefore this is not a growth account. This one is what the viewer has defined basically to be like a spending account. So this is our spending account in scenario 1. This is our growth account in scenario 1. But the point is those terms are just defined by the user, what they're using these accounts for. There is no such thing as a growth quote-unquote Roth account. A Roth IRA is just a Roth IRA. You can use it for a growth strategy, for an income strategy, or whatever kind of investment strategy you want. But I just want to make it clear that that is a user-defined description. It's not an actual type of Roth IRA. Okay, so for purposes of this example, we will just assume the opening balance in the Roth IRA is zero. Our $50,000 conversion from the traditional right here will go directly into the Roth IRA there. So in year 1, our balance after conversion will be $50,000. I'm going to apply the same 4% growth rate on a monthly compounding basis to this balance. And at the end of the first month, we're going to have $50,167 in the Roth account. That balance will carry over to the beginning of February. We don't have any additional conversions for the year in this fact pattern. And then the process will continue for the remainder of the year with no distributions until we get to an ending balance of $52,037 in the Roth. Okay, now next up, let's do the taxable income calculation for scenario 1 for this year. The first thing we have is our grand total traditional IRA distribution. That amount is $102,180. That amount comes from right over here and is the sum of all of these $8,515 distributions, one for each month. As you know, distributions from a traditional IRA are generally taxable, unless you had non-deductible contributions at some point in the past, which we're just going to assume is not the case for this example. Therefore, this full $102,180 will be taxable income for the year. year. So that will be the first item on the list right there. Now the next item will be the grand total Roth conversion right here of $50,000. We're going to put that $50,000 on the second row of the taxable income calculation. The third item will be Social Security income, which, as you recall, the user defined to be $50,000 for the year. Social Security is taxable at a maximum of 85% based on other income. In this case, we do have sufficient other income to cause the Social Security to be taxed at the maximum of 85%. So 85% of $50,000 is going to be $42,500. The grand total of the income right here on these three lines is going to be $194,680. We're going to have a standard deduction for this year of $30,750. For purposes of this example, I'm just going to assume that we're doing a 2024 calculation so we can tie these numbers out to TurboTax in just a moment. In that case, this standard deduction would consist of $29,200, which is the general standard deduction for 2024, plus another $1,550, assuming that one spouse is age 65 or older. And so when we take our total income of $194,680 and we subtract off the standard deduction, that gives us taxable income for this scenario of $163,930. Okay, so before we continue, let's do our first TurboTax tie-out. We have two distributions from a traditional IRA, $102,180 plus another $50,000. The grand total of these two numbers is $152,180. Going over here to our TurboTax tie-out page, there's our $152,180 on line 4B, which is the taxable amount of IRA distributions. The next item was the $50,000 of Social Security that we said was taxable at 85% for $42,500. There's the grand total $50,000 Social Security, and TurboTax here is confirming $42,500 is taxable. So there's our total income of $194,680. There's our standard deduction of $30,750, and there's our taxable income of $163,930, which agrees to what we have right here, $163,930. So that summarizes our taxable income calculation for the year for scenario 1. Next up, let's do our after-tax cash flow analysis for scenario 1. So we're going to do the cash flow analysis on a quarterly basis because we're going to have to make quarterly estimated tax payments. So starting right here, this is the first component of our cash flow that we are using for living expenses for the year. If I double click on this cell right here, you can see that it's the first 3 months of the IRA distributions of $8,515. That's going to be the same for all 4 quarters, leading to a grand total of $102,180, which agrees to this number right here. The next item in our cash flow analysis is the Social Security income, also broken out by quarter. If I double click on this cell, you can see I've simply taken the $50,000 grand total and divided it by 4. Remember, for cash flow purposes, the user has stated we are receiving $50,000 of cash from Social Security for the year. So from a cash flow perspective, we have $50,000 of Social Security, even though from a taxable income perspective, we only have $42,500, which is actually a taxable item. Now, real quick, why is this $50,000 Roth conversion not included anywhere down here in the cash flow analysis? And the answer is because that's not part of the monthly cash flow that we're using to cover expenses. This $50,000 of conversion right here is sitting over here in the Roth IRA, the growth Roth IRA, specifically not being used to cover monthly expenses. Therefore, this $50,000 is not part of the cash flow that we are dealing with down here. Okay, now offsetting our cash inflow in the analysis is going to be the estimated tax payments that we have to make each quarter. Now, how do we determine what those payments are supposed to be? Well, step 1 is we have to estimate what our tax is going to be for the full year. So if we go back to our TurboTax tie-out for scenario 1, there's our $163,930 $163,930 of taxable income, and we have projected total tax of $26,171 for the year. Okay, now that we have the total tax for the year, we're going to go to our Number Crunch Nerds Safe Harbor Estimated Tax Calculator. We're not going to comb through the calculator in detail in this particular video. If you want to see a complete video on how the Safe Harbor Estimated Tax Calculator works, go to my YouTube channel right here, and you're looking for this video right here, Estimated Taxes Safe Harbor, how to calculate with a full example. But for purposes of this video today, we're just going to enter our current year projected tax total, which we determined to be $26,171. And in this case, the result will be 90% of the current year tax due will be the minimum safe harbor. That amount is $23,554. And when broken out to the quarters, it's about $5,888 per quarter. All right, now going back to the after-tax cash flow analysis for scenario 1, I'm going to make a slight adjustment to the estimated tax payments that we're going to make for purposes of this video. Instead of the $5,888 per quarter, which is based on 90% of the tax due, for simplicity, I'm just going to say that we're going to pay in 100% of the tax due, and we're going to break that out by quarter. So recall what the difference is. Under the safe harbor method, if we owe $26,171 for the full year, we are allowed to pay in 90% of that, which equals $23,554 broken out over the 4 quarters, but we will still owe the remaining amount with the filing of our return. In other words, the difference between $26,171 and $23,554, which is about $2,600 of difference, that $2,600 is still owed for the year. We're just allowed to push it off until the actual filing of our return on April 15th. But to keep things simple over here, I'm just going to say that we pay the full amount of $26,171, which is the total projection for the year, which we got off of our TurboTax tie-out. We're just going to divide that evenly between the 4 quarters so that we don't have to deal with lower amounts in each quarter and then an additional $2,600 on April 15th. We're just going to do it evenly throughout the year, and then when we get to the filing of our return, the full $26,171 would already have been paid in, and therefore no additional tax would be due with the filing of our return, assuming that the numbers came out as projected. So with all of that in mind, if I double click on this cell, you can see I've just taken the $26,171 and divided it evenly between the quarters. So that's a $6,543 estimated tax payment that we would have to make each quarter in this scenario. And then if I double click on this cell right here, the total after-tax cash flow for the quarter is going to be the sum of the amount from the IRA distribution plus the Social Security minus the estimated tax payment that we had to make, resulting in $31,502 for the quarter and $126,009 for the full year. So those are the results of scenario 1, but we need something to compare that to. We're going to do scenario 2 as defined by this viewer. Let's go back over here to the original fact pattern. This right here, what the user defined as the typical method, is what we just covered in scenario 1. Now we're going to go down here to the last part of the email and lay out the better method as defined by this user. So it says the better method is to convert $50,000 to the Roth growth account like above. So that part is the same, but convert the $100,000 for annual expenses and tax payments on January 1st into a designated Roth spending account. So again, this is where the user is defining 2 accounts, one to be for annual spending and one to be for growth. So the big big difference here is now that the spending account is no longer going to be a traditional IRA. The spending account will be a Roth IRA. And so the full $150,000 that started in the traditional IRA will be completely converted over to Roth on day one, on January 1st. $50,000 to the Roth growth account just like before, and then $100,000 to a different Roth account, which we will then use to do our monthly distributions for cash flow and expense purposes. And so it says, why is this better method better? The answer, given the $100,000 sits in the Roth instead of the traditional IRA for the year, on average, this will be $50,000 earning 4%. I believe what this statement means right here is that if you have $100,000 sitting in the account on day one and you distribute it evenly over the course of the year until the balance gets down to zero, just like we saw in the previous example, then on average you would have half that amount of money sitting in the account for the year, so you'd have $50,000 in there on average. So instead of the planned spending sitting in the traditional IRA and adding $2,000 to the traditional IRA during the year, it is now in a Roth earning 4%, and now we have $2,000 more in a Roth. Why not advocate this strategy? Okay, so with this revised fact pattern, let's go lay out the numbers and calculate the results for what I'll call scenario 2 right here. All right, so now in scenario 2, here is the traditional IRA. This is what the viewer defined as the better method. So for this one, remember, we still have the same $150,000 opening balance in the traditional, but now we're going to do a complete conversion of the balance on day one. We will now have two Roth IRA accounts in scenario 2. The first one will be designated as Roth spending. This is the one from which we will take our monthly distributions to cover expenses and taxes. And then our second Roth IRA will be the growth Roth IRA. And so of that $150,000 conversion on day one of the year, $100,000 will go into the spending Roth IRA, and the other $50,000 will go into the growth Roth IRA. Okay, now I'm not going to belabor these two calculations because conceptually they will be the same as what we just went through above. Let's just quickly run through the first two lines. So right here we're going to assume an opening balance of 0 in the Roth spending account. There's our $100,000 of conversion. There's our balance after the conversion. There's our annual 4% return compounding on a monthly basis. There's our balance after the return, and there is our $8,515 distribution. There's our balance after the distribution, which carries up to the beginning of the next month. And then the calculation will continue just as before, the only difference being now that this is occurring inside of a Roth IRA instead of a traditional IRA. The amount of the distribution per month will remain the same at $8,515. The total amount of distributions for the year will be $102,180, which is the same as the previous example. Those are the amounts of distribution needed to get the balance down to 0 in the spending account by the end of the year. And then over here in the Roth Growth IRA, the calculation is identical to the one above. In fact, instead of walking through it, let's just go ahead and show that the result at the end of the final month, 52,037, if we scroll back up here to scenario 1, 52,037. So the Roth IRA designated as the Growth IRA, those two amounts are identical between the two scenarios. Okay, so next up, let's do the taxable income calculation for scenario 2. The first item on the list will be the Roth IRA conversion that went to the spending account. That was $100,000. The second item is the Roth IRA conversion that went to the growth account. That was $50,000. The Social Security income is the same at $50,000 gross and $42,500 taxable. So that leads to total income of $192,500 in scenario 2. Let's just remind ourselves that these distributions now are not taxable items items because they're now coming out of a Roth IRA instead of a traditional IRA. So this information over here will not be part of the taxable income calculation. We're going to have our same standard deduction right here of $30,750, and so our taxable income in scenario 2 will be $161,750. All right, let's quickly do our TurboTax tie out. For scenario 2, we have $150,000 total of taxable IRA distributions. Here's our scenario 2 tie out. There's the $150,000 of taxable IRA distributions there on 4B. Social Security was the same at $50,000 gross and $42,500 taxable. We have the same standard deduction right there, and we have taxable income of $161,750, which agrees to our $161,750 right here. Okay, next up, let's do the after-tax cash flow analysis for scenario number 2. Now, for the Roth IRA distribution component that we are using to cover our living expenses as well as estimated taxes, those amounts will be the same as they were in the previous example, with the grand total being $102,180. Now, let's think about that for a second. Why are these identical between the traditional IRA distributions and the Roth IRA distributions from a cash flow perspective? And the answer is because these two spending calculations, whether the spending account is a traditional IRA or a Roth IRA, these two spending calculations are identical. We have a $100,000 balance to start. That is the same in scenario 2 as it is in scenario 1. We have the same 4% annual rate of return compounding monthly. We have the same balance after return each month, and we have the same amount of monthly distribution. So if we have the same amount of cash, $8,515, coming out of the spending account each month, regardless of whether the spending account is a traditional or a Roth IRA, the total amount of money coming out of the spending account for the year, considering the 4% rate of return, which again is identical between the two scenarios, that total amount is $102,180. So this column right here in scenario 2 is identical to this column right here in scenario 1. Now the next item, Social Security, that is also going to be identical in scenario 2 as it was in scenario number 1. There's no difference between the two strategies from the perspective of receiving $50,000 of Social Security and having that Social Security be taxable at 85% either way. Okay, now in the estimated tax payments column, this is where we're going to discover our difference. Going back to our TurboTax tie-outs right here, in scenario 2 we had taxable income of $161,750, leading to total tax projected for the year of $25,691. In scenario 1, however, the amount of tax projected was higher at $26,171, and that's because the amount of taxable income was a little bit higher, and that was driven specifically by the extra $2,180 that was a taxable traditional IRA distribution in scenario 1, but it was not a taxable traditional IRA distribution in scenario 2 because it was coming out of a Roth IRA in scenario 2. And this is what the viewer was talking about right here. So instead of the planned spending sitting in the traditional IRA and adding about $2,000 to the traditional IRA during the year, it is in the Roth IRA earning the 4%. So now we have an additional about $2,000 more in the Roth instead of it being in the traditional. That statement is becoming visible right here. We have about $2,000 more in the traditional in scenario 1. That's why there's $2,180 more of taxable income right here. But in scenario 2, the $2,000 is sitting in the Roth, is distributed from the Roth, and therefore it's not part of this taxable income calculation. So following the same methodology that I used in scenario 1 of just paying 100% of the estimated tax due for the year evenly across the quarters to keep things simple, our quarterly estimated tax payment in scenario 2 is now $6,423, but it was $6,543 163 in scenario 1. So coming back down here, because our estimated tax payments are a little bit lower in scenario 2, our after-tax cash flow is a little bit higher at 126,489 versus 126 and $9 up here in scenario 1. Okay, so now that the calculations for scenario 1 and 2 are complete, let's reconcile the results here and see what the differences are. So from a pre-tax cash flow perspective, in scenario 2, we had $152,180 of pre-tax cash flow. That number comes from right here. It's the sum of the Roth IRA distributions that we're using for expenses plus the Social Security income that we're using for expenses. If I double click on this cell, you can see it's the sum of those two numbers. That's our pre-tax cash flow. Now in scenario 1, our pre-tax cash flow was identical. Right here we still had $102,180 of cash distributions coming out of the traditional IRA, and right here we also had $50,000 of income coming from Social Security. So from a pre-tax cash flow perspective, there is no difference between the two scenarios. Now what about on an after-tax basis? Well, in scenario number 2, we had after-tax cash flow of $126,489, which came from right over here. And in scenario 1, we had $126 and $9, which I just showed you above. That number came from right here. So since we have higher after-tax cash flow in scenario 2 versus scenario 1, our resulting tax savings in this fact pattern is $480. Now let's just run through our income tax reconciliation to make sure we understand where the $480 is coming from specifically. In scenario 1, our taxable income was $163,930. There's the $163,930 right over here. In scenario 2, our taxable income was $161,750. There's our $161,750 right over there. So we have a reduced taxable income in scenario 2 of $2,180. That's the same $2,180 we were just talking about a few moments ago, right up here where I was comparing the taxable IRA distribution between scenario 1 and then scenario 2 over here. And so the question for you is, what marginal tax bracket is this savings occurring in? Well, to figure that out, let's just quickly look at our taxable income is in the $160,000 range. We're going to go over here to our rates and brackets. $160,000 is larger than the top of the 12% bracket. It's also smaller than the top of the 22% bracket, which means we are in the 22% marginal bracket. Therefore, this tax savings is occurring at the 22% marginal rate. And so if we take our reduced taxable income of $2,180 and we multiply it by our marginal tax rate of 22%, that is where our tax savings of $480 in this fact pattern is coming from. So with those results in mind, I agree with the user who provided this information in this fact pattern. Scenario number 2, which was defined as the better quote-unquote scenario, does produce a better after-tax cash result, being driven by $480 in reduced tax for the year. So going back to the final question posed in the email, why not advocate this? And the answer for everybody watching is I do. In fact, what do you think this video is right over here? Hardcore tax planning in 90 minutes. This, by the way, is part number 9 of the Roth IRA conversion video series on YouTube. This was the Johnson family versus the Miller family example, and what was the number one takeaway from this video? You'll recall it was that tax deferral, just for the sake of tax deferral, is not how you get ahead on an after-tax basis. Recall from this video show that Mr. Johnson was ahead and Mr. Miller was behind by $19,000 in tax savings from Roth IRA conversions, plus another $5,000 from investment return on the converted funds that were now in the Roth IRA instead of the traditional IRA. Take note of the fact that in that video example, the bulk of the savings was from the Roth conversion itself, and the smaller portion of the savings related to the return on investment. Conversely, in the current example that we just went through, the tax savings exclusively relates to investment return and not to the Roth IRA conversion itself. How can we confirm that? Let's go back right over here to scenario 1. I'm going to go down here to this cell right here. I'm going to type in equals sign sum open parenthesis. I'm going to grab all of these numbers in the return column. I'm going to hit close parenthesis and enter. The 4% return compounded on a monthly basis is where the $2,180 difference comes from. Just like the viewer who provided this example specified, this $2,180 of growth is occurring in a Roth IRA in scenario 2, but it's occurring in a traditional IRA in scenario 1. We already proved right down here that it's that exact $2,180 of investment growth that is leading to this $480 of tax savings. So again, it is specific to only the investment growth in this video's example, whereas in Roth IRA conversion video series number 9, the Johnsons versus the Millers, the bulk of the savings related to the Roth IRA conversion itself. Why is that? That is my question for you. Why did we see a big tax savings on the Roth conversions themselves over here, but in today's example, we only see the savings related to the investment return itself? And the answer is because realizing tax savings from a Roth conversion is a concept that only applies over time. That's why inside of the personal tax planning template, we do multi-year tax planning. Conversely, in today's example, in both scenario 1 and scenario 2, we did not do multi-year tax planning. We only did 1 year of tax planning in isolation. And it should make sense to you that tax savings from Roth conversions only applies over time because the money being converted was earned in a different tax year than the current year when it's being converted. Conversely, tax savings on investment return is a concept that applies to both the current year as well as over time. It applies to the current year because the return is being earned in the current year, as we just saw in this video's example, and it applies over time due to the effects of compound interest. But the conversion itself relates to income earned in one tax year but converted in another tax year, and that is why we have to do multi-year tax planning inside of the personal tax planning template, because again, the tax savings from Roth conversions, which can be quite significant in comparison to the tax savings on just the investment return alone, that tax savings is only a concept that is realized over time. That's why when somebody comes into the office and says, I want to save on taxes this year, the only thing I can do is say, that's nice, I appreciate that's what you want, and we'll do everything we can to identify tax savings that can be found this year, just like we found some tax savings this year in this video's example. But then the client needs to learn that the real money is found over time. Roth IRA conversions can save your family tens of thousands, even hundreds of thousands of dollars, just depending on the size of the numbers you're working with, but only over time. Most Americans don't think about things in terms of over time. Most Americans are too busy with tweets and Instagram posts and instant dopamine rushes to stop for even a moment and realize how much of their life's hard-earned toiling is about to get taken away from them by the government when they get slammed in RMD territory. I've showed you this comment from a member of the Personal Tax Planning Template program before, but I'm going to show you again because no comment could encapsulate this issue more articulately than I wish I had paid more attention to the tax implications of retirement when I hit 60, and I have encouraged others to learn from my mistakes. I'm now turning 73 this year and am facing large RMDs. Some Americans will realize that the time to start laying out that lifetime tax plan is right now, and some won't. What can I say? So if you're interested in becoming a member of the Personal Tax Planning Template program, lifetime access to the program is available for a one-time access fee at the link in the description below this video. Your purchase of the Personal Tax Planning Template program helps out the channel and provides you with a tax planning and training toolset that you can use throughout your life to help minimize your taxes and maximize the after-tax cash flow that remains in your family's pocketbook. So it's a win-win for everybody. And if you're new to the channel and would like to learn more about the Personal Tax Planning Template and see it in action, then make sure to check out my currently 10-part Roth IRA conversion video series on YouTube, which you can find by simply searching on YouTube for Number Crunch Nerds Roth IRA Conversions. So that's going to be it for today's video. Thanks everyone for watching, and I'll see you next time.